To our focus on the day now, the Finance Act 2020 in January, that's in the 2021 budget, and the Finance Bill 2020, both assented to by President Muhammadu Buhari, will go into effect. As this will restore Nigeria's budget cycle to a predictable January to December calendar. For the 2020 budget, the restorative goal was achieved, and the budget signed into law on December 22nd, 2019. It took effect from January 2020. The 2021 budget has seen a similar adherence, with the President signing into law on the last day of 2020. The new Finance Act 2020, which should go into effect this month, introduces a number of tax relief positions or provisions for the benefit of individuals and small businesses, bringing about changes to Nigeria's tax laws by making them fair enough and more responsive to the tax reform policies of the federal government, enhance its implementation and effectiveness, improve the ease of doing business, and also support the funding of the 2021 budget and subsequent subsequent budgets. Where the country is still reeling from the impact of COVID-19 pandemic, a slow recovery is being projected by these likely reforms to inform modest and revenue expectations in the budgetary assumptions for oil revenue. It is clear that the economy will still require infusion of fiscal palliatives to help keep businesses afloat, inclusive of deferral of tax payments and possibly statutory transfer. Indeed, I have joining me in the studio this first Monday of the month of January in the new year 2021 to give an insight into our topic of discuss is the managing consultant at Pedabo. Thank you very much, Mr. Albert Folorunsho, and it's a happy new year to you.
Thank you.
It's great to have you in the studio.
Thank you.
When I thought about this topic, it was you. My mind went to immediately that you're going to be the right person to break this up. First, give us a highlight into the main changes, various tax acts amended from a lot of them, CGT, IDI, TRA, CITA, PITA, VAT, stamp duties, and we can go on and on. Just give us what are the highlights of these main changes.
Thank you very much. It's a very detailed bill, which has now been passed to law by the President on the 31st of December, covering all of those taxes you have mentioned. The Capital Gains Tax Act, the main issue on the Capital Gains Tax is the need for taxpayers to file capital gains tax returns like twice a year on the 30th of June and on the 31st of December, so that any disposal made during those two periods, the capital gains tax can be paid as quickly as possible. And again, there was a minor error in the 2019 Finance Act, which has now been corrected, such that the exemption for compensation for loss of office is subject to a maximum of 10 million, so that if your compensation is more than 10 million, the excess is liable to tax at 10%. And then the responsibility for collection of that tax has now been moved to the employer, who will pay the compensation. Okay. Then if you move into CETA, government has looked at the possibility of making the incentive available to banks who gives a Greek loan. Okay, so they have now reduced the moratorium period from 18 months to 12 months. Okay, and the rate of interest, not more than the base lending rate at the time the loan was granted, refinanced or restructured. Okay, that was a major one, basically for agricultural company. And then Section 13 that has to do with taxation of a non-resident entity. Okay, the provision regarding consultancy professional fee has also been amended, such that it is only where the provision in Section 13 that has to do with fixed base, dependent agency, okay, if they are not present, that the withholding tax will be taken as final tax. Okay. Then there is now a provision in amendment in Section 14 that has to do with shipping companies and airlines, okay, foreign airlines, okay, and so the import of that is that the exemption for those foreign airlines, stops at where they carry out, taking out of passengers and goods from Nigeria. Anything they do in the hinterland, maybe after bringing goods to the port, they now take it from the port maybe to Ibadan and all that. Those ones are deemed to be, transactions in Nigeria, and should be liable to tax. That's the amendment in Section 14. In Section 16, a small amendment as to the definition of insurance premium gross premium for the purpose of minimum tax computation. And the fact that for all companies now that have been in business for at least 4 calendar years, the minimum tax that was 0.5% of turnover under the 2019 Finance Act has been reduced because, of course, the impact is huge. And we're hoping that maybe down the line, the issue of minimum tax will be removed totally. It has been reduced from 0.5% of turnover to 0.25% of turnover. Again, to compensate or to appreciate those who have made donations to the federal government or state government for COVID or any pandemic, okay, they are now allowed to make a deduction, okay, from their profit, not more than 10% of the accessible profit, after all other donations and labor expenses have been deducted. Okay, that is, just to encourage people to make a donation to such a provision. Then again, in Section 39, that has to do with downstream utilization of gas. Okay, an amendment has been made such that it is only companies that have enjoyed incentive under any other law will not be entitled to claim those incentives. Okay, with effect from this Finance Act. So, which means if you are an upstream company and you utilize gas, the provision is that the gas is not liable to petroleum profit tax. So you pay company income tax at the rate of 30% as against 85%. Okay, if you have enjoyed that benefit, the provision is such that you cannot claim Section 39 relief again by getting your profit exempted from tax for 3 years, which can be extended for additional 2 years. I think that is the essence. Again, the Establishment Act, which is the FRS Establishment Act, okay, was amended to enhance.
Yeah, I was thinking about that. I'm thinking how that will impact revenue generation, on what right that the taxpayer has in such abuse of powers, because some believe that this power, talking about the FRS Establishment Act.
Well, the FRS Establishment Act, they are the main revenue generating agency of the government. Yes. And so they desired that power so that they can deploy a proprietary platform and digital technology to collect, and follow up the revenue. Okay. And so the provision that has been included is such that before such deployment, the first thing is that it must be proprietary, which means it shouldn't be platform of consultant and all that. It must be something that is proprietary to FRS, and the FRS is required to give a 30 days notice to the taxpayer before deploying such technology. And so if you have been given such a notice and you have an objection, you can raise it. Okay, but of course, we know that that is the way to go. There's a need for the FRS to be able to generate revenue. We had the president, when the Finance Act was being signed, emphasizing the fact that all revenue agencies must meet their targets. And I think that will help the FRS in tracking all leakages here and there. And so, of course, the taxpayer has the right to object if they have strong reason why such technology should not be deployed.
Indeed, you spoke about the specific provisions to compensate companies that contributed towards the COVID-19 pandemic and what government will be doing to help them. But under what circumstances will penalties and interest for late payments of income tax apply from the due date for filing income tax returns? Okay,
so that is Section 53. The desire of the Federal Revenue Service or tax authorities to ensure that penalty apply from the due date of filing, which means if your accounting year end is December 2020, the return is due by June 2021. And if 2021 you will fail to file, 2022, 2023, you eventually file, the rule is that you should ordinarily be liable to penalty and interest from the effective date of filing, which is 2021. But for that to happen, the provision is saying that there must be deliberate or dishonest, attempts to shield income from tax. So it is not just general. There must be, the FRS must be able to ascertain that that deliberate attempt has been made that the taxpayer to avoid tax or to evade tax, if you like. Okay, so if that is not there, the normal flat penalty should still apply.
Okay, then. Now, minimum wage earners are also to be exempted from tax from 2021. Are they still required to file tax returns through their employers?
Yeah, the provision is that with effect from 2021, if you are a minimum wage earner, that is, you earn not more than 360,000 a year. Okay, and you are an employee, okay, not self-employed person.
Okay.
You are an employee. That minimum wage is not liable to tax. In fact, it's not liable to minimum tax. But for record purpose, the employer is still required to include them when filing the tax returns. So they are not exempted from filing returns. Okay, those that are exempted are those who earn no more than 30,000 a year. Okay, they are not minimum wage level. You still required to file return, but that does not mean that such a person is liable to tax. Another significant thing under the personal income tax is the fact that the significant economic presence that was applicable under CETA, that was brought into CETA in 2019, has now been included for individuals that are non-resident but have significant economic presence in Nigeria. And so such person may be liable to income derived in Nigeria. Again, the consolidated relief allowance, okay, which is the maximum allowance that a person is entitled to as a deduction from employment or from income generally. The calculation of that has been streamlined such that it is only those income that are liable to tax that should enjoy that relief. If you have income that are not liable to tax, you shouldn't be claiming CRA on such non-taxable income.
So we're under the CGT compensation for loss of, I thought you touched on that too, loss of up to 10 million are also exempted from tax. Does this include gratuity and other severance pay? No.
You know, when you say severance pay, the composition can be different. The one that is covered under the CGT Act is the one that is compensation for loss of office. That is, you are on a contract employment and the employment is prematurely terminated. You are an employee without notice. You are just told that your activities have become odious to activities of the company. So which means you are sacked without any notice. And then for that reason, you are paid a certain sum, maybe 20 million. If you are paid 20 million, the law says the first 10 million will not be liable to tax. The balance of the 10 million will be liable to CGT at the rate of 10%. And it is the employer who is paying you that should account for that. Ordinarily, before now, when it comes to CGT, the employer has nothing to do with it. There's no withholding tax or payee applicable to CGT. But with this provision, the employer now have to account for that specific tax.
Also, a new definition of almost of the CRA computation has been included in the PITA. That's personal income tax.
Yes, I just explained that.
Yes, you know, what about the implication now on taxpayers themselves?
Well, I don't expect that if you have been computing your tax properly in the past, it shouldn't have any impact at all. I mean, maybe if you are a self-employed person and you have income from other sources, the issue that the revenue has had was taxpayers trying to claim relief on trading income before deduction of capital allowance. Okay, but of course it should be after deduction of capital allowance, and then you shouldn't be claiming CRA on employer's contribution. It's ordinarily not part of your employment income, even though we know it's part of cost to company. But that is not taxable, and therefore CRA should not apply on it. So that is just the basic issue around the personal income tax. Yes. Then, of course, we have the issue around the Custom and Excise Tariff Act, which now gives some reduction in the levy and the duty that is applicable.
Some vehicles and
tractors. Yes. So, effective from 2021 now, duty on tractor, is now reduced from 35% to 5%, while duty on motor vehicle for transportation of more than 10 persons has been reduced from 35% to 10%. Then for normal vehicles, that we all use, these are expected to be new vehicles, really. That has been reduced from 30. The levy, there's a difference between a levy and the duty.
Yes.
The duty still remain 35, but the levy has been reduced from 35 to 5%. So which means effectively on vehicles now, it will be 35% duty plus 5% levy, making it 40. So dropping from, the SY 70% on vehicles that we used to have. And of course, the objective of this is to open up, to increase revenue generation, and then so that we can increase patronage of the Nigerian ports. A lot of all these smuggling activities will be reduced because of the huge amount that people are trying to avoid. This is expected to reduce the impact of that, and people will begin to patronize Nigerian port more. hopefully the traffic in Apapa will be removed. So will be reduced so that the impact of this will be felt. Of course, the local producers too. We hope that they'll be able to produce more, because the more cars we are produced locally, the less we will need imports. And those are some of the things that were considered.
Reading through this, I also got that I was going to ask you to briefly explain to us, the Nigerians, the new definition of goods and services in the VAT Act. How does this impact on rent, and what's subject on rent? That was a subject of controversy, because I think there was a time we talked about the stamp duty thing over rent. And can you take us through what the implication of this is?
Well, the new provision has said that VAT will not apply on land and building, and that is as good. It will also not apply on services that relate to interest in land. Now, when you talk about interest in land, it also applies to rent. So, which means based on this Finance Act, there should be no VAT on rent and lease, on property, not other leases or rentals. On property, there's no VAT on land, there's no VAT on building. Okay, the idea is that property is more or less individual and corporate related, and therefore, maybe when the stamp duty is fully reviewed, they expect that the stamp duty will be more on properties and securities. And so you cannot apply VAT on buildings and rents and then apply stamp duty at the same time. Okay, so I assume that this is a preparation for a review of the Stamp Duties Act. So going forward, we don't expect VAT, which aligns with the recent ruling of the court, VAT on rent. We don't expect rent of building. Let's be specific. Then there's no VAT on purchase of property, and of course on land. Okay, and that is the import of the revised definition.
All right. Now, another one is the sharing formula of 15% for federal government and FCT, and 85% federal government and FCT, and 85% to states on derivation has also been included.
Well, that has to do with stamp duty. Stamp duty is as provided under Section 163 of the Constitution.
Yes,
is to the effect that stamp duty is actually due to the state, okay, after deduction of collection cost. The provision says net proceed should be shared among the state on the basis of derivation, and that applies to the stamp duty of any form, including electronic transfer levy. In 2019 we have this electronic transfer stamp duty. Okay, all these the 50 naira debits that you have when you make a transfer. Okay, that has now been characterized to be electronic transfer levy. Okay, and for me, it's not too far away from stamp duty. And so, whether it is stamp duty or electronic levy,
yes,
the distribution formula, which has been suggested here, is that 15% will go to the federal government and FCT, while 85% will be distributed among the states on the basis of derivation. The question really is, how will that derivation be done? Who determines who gets what? Okay, we expect that a lot of people are in Lagos. So when you transfer money, if you check your account, the debit goes to your account when you make the transfer.
Yes.
So which means you are the one bearing the stamp duty.
Yeah.
And so if you are a resident in Lagos and you are debited for stamp duty, automatically it should go to Lagos State. Okay? But of course, that is not part of the determination of that has not been clarified in the Finance Act. We believe that will be neck problem. The National Executive Council to determine, okay, because we also know that they have a VAT sharing formula. This is now a new sharing formula. We will be getting the details from the federal government. But the most important thing is the fact that stamp duty or electronic transfer levy does not change from what taxpayers were paying before. It is just who collect and who share what that has been addressed in the Finance Act.
All right. Now NIPOST are to sell adhesive stamp to FRS. Or what's the role of NIPOST in all of this?
The controversy around stamp duty.
Yes, I spoke to the GM, the chief postal, at a particular time about these issues. What's this conflicting?
Well, I think it's the word stamp duty. Stamp duty does not mean postage stamp. Stamp duty is duty payable on instrument or document. okay, instrument on document. To make such a document have a legal backing, I mean, to be given, to be admissible in evidence in a court of law. And therefore, it really has nothing to do with a NIPOST. Yeah. But of course, with this provision, it says that if FRS has to use adhesive stamp to denote any of the stamp duty that is due on any of their receipt or instrument, okay, that FRS can defer to NIPOST. Oh, I need so much in adhesive stamp. NIPOST, can you supply? That is the way I see it. It's not that NIPOST is now collecting any stamp duty. NIPOST is to provide FRS with adhesive stamp where they need anyone. All this electronic transfer, you don't need any adhesive stamp. Nothing is being stamped. You just see debit in your account, yes, and 15 naira is debited. You don't even get to see any document. Electronic. Okay? Even where they want to do electronic stamping, you don't need adhesive stamp. So FRS will probably not need NIPOST to that extent. The only thing now that appears to me is that FRS will not need to produce the revenue stamp that they have already produced. Okay, maybe when they finish the one they have in stock, they will now defer to NIPOST to make the adhesive stamp available to them.
I want to talk about this one. It has to do with the dividends, unclaimed dividends. That's really key. And the dormant bank balance fund been passed into law by this act. Now, what is the implication? Does this mean the federal government will take over such funds? That is one. You know, because I'm looking at how beneficiaries will have access to the fund and come to claim them.
Well, the name, like you said, is unclaimed dividend and the dormant account balance. Unclaimed dividend means that you have dividend that has accrued to you because you're a shareholder of a public company for this purpose, okay, and you have failed to claim the dividend. So the money remains with who? Either with the company or with the registrar, who are supposed to make the distribution, okay? And from what we are aware of, is about 150 billion that is in such accounts all over the place. So what federal government, I mean, as a way of helping in funding the budget, that is the way I see it, is that instead of public borrowing or borrowing from the international community, government is going to have access to this fund. I expect that from the provision, the unclaimed dividend and dormant account fund will be managed by a governing body, okay, chaired by the finance minister and an individual in the private sector appointed. Okay, the debt management office will be the office that will manage the fund. Okay, and of course we have representative of the shareholders association that will be present. Okay, of course the CBN governor, the debt management office, NDIC, and all of them will be in the governing council. So the essence is to ensure that this fund is managed. It is not that government is taking over the money. If you have not claimed your dividend and you now have evidence to claim it, you can still go ahead and claim it. Go through your registrar. The registrar will liaise with the debt management office, and the fund will be made available. In fact, with a yield. Before now, when you have unclaimed dividend and you want to claim, you just get the face value of the dividend. Of course, before any fund gets to the unclaimed dividend fund, it must have been outstanding, it must have been unclaimed for at least 6 years, even though KAMA says 12 years. But this provision says 6 years. Okay, and then of course, the dormant bank account balance, if you fail to, if your account becomes dormant for over 6 years, the fund will be transferred. It is not that the fund has been taken over by government. Okay. If you wake up tomorrow and you want to claim your money, you can still claim your money. But it's just that you now have to go through process. The essence is that somebody has said that registrar is private, individuals are private. It is better your money is in the hand of government. Government is not likely to die in the future, and then you can always make your claim. And of course, we expect that since it's going to be managed by the debt management office, some element of yield to come on top of whatever you now claim. Remember that these are funds that have not been claimed, and it's not like they're taking anybody's money. Okay, they are people's money. There has been argument that, oh, why not leave the money back to the company and all that. They are no longer fund that belongs to the company. They belong to the shareholders, and they should be where they can be claimed at any point in time.
So the shareholders will be protected in all of this?
Yes, there are two members of Shareholders Association that are members of the Governing Council, okay, as prescribed in the Finance Act. Okay, I believe they are more than enough to protect the interests of the shareholders. to be sure that their fund is not lost.
A lot of issues have been addressed here, but in your thoughts, yes. This document is supposed to help government in funding and all of that. How well do you see government achieving what they intend to achieve following through this document? Okay,
so we have a 13.8
yes.
trillion budget,
yes.
Out of which only 7.8 or is it 8.9 is
about 7 points.
Okay, that can be have fund for, while yes. the balance is to be borrowed.
Yes.
Okay, so the first thing is that the one that has been projected not to be borrowed, the government must be able to raise the revenue to fund that aspect first.
No excuse.
Yes, and the bulk of it is coming from the federal revenue and service, and so they must be provided with that environment, that power to be able to generate the required revenue. Okay, and that is where the issue of deployment of technology comes in. Okay, again, we have the level of compliance. Sometimes if the tax is excessive and not justifiable, people will decide not to comply. So I support the idea of reducing the minimum tax rate from 0.5 to 0.25%. That will make more people to comply. Because if you really cannot comply in a pandemic situation like this, you will rather not pay anything. Okay, so, but if it is something that is minimal, hopefully we expect that even though it's supposed to be for the reduction from 0.5 to 0.25, it's for a sunset period of 2 years. We hope that by the expiration of the 2 years, maybe the 0.25% will be sustained, okay, or even reduced further or eliminated as claim on if you don't have profit, you shouldn't pay tax. But that is by the side. 2, government has the issue around the custom and excise tariff act. It is the introduction of excise duty on telecommunication service. It's also in this act, but that has to be triggered by the president. So which means for telecoms now, federal government can introduce excise tariff, which is also applicable in some other African countries. Okay, even though it has not been specified here, it's been included in the Finance Act. That will help generate more funds. But of course, the government will need to think through that, looking at the taxpayer's position and having to bring in additional burden. The thrust of this bill generally is not to give extra relief and not to introduce any excessive tax.
Not to introduce any burden. Nigerians need to understand.
Yes, not to introduce any burden on the taxpayer, not to introduce new tax and all that. Okay, so that is the thrust of the bill. I mean of the act now. And I think going through all of that, it is well covered. For example, I can see here that they have removed VAT on domestic flights. If you're flying to anywhere in Nigeria, VAT has been removed. Okay, so that will reduce the burden on taxpayers. Okay, and of course, if VAT is a decision for you to fly, now you can fly,
yes,
and then the the airlines will come back to business. Okay, so there are a lot of things that are conflicting, which government is trying to balance here and there.
Let's touch again before we round off on this for companies that have contributed towards COVID-19.
Yes.
In the start of this discussion, you shared some of your thoughts around that. But yes, in specifics, what are the specific provisions to compensate them?
Okay, that is in subsection 8 of the section 25, I think, of the Companies Income Tax Act. Provide for this. Now, when you make donation in capital, okay, is not an allowable deduction. But with COVID and with this specific provision, even if the donation is in capital, if you have provided equipment, a PPE, and all that, you have acquired it, and I'm sure there are private funded COVID centers like the one at Onikon Stadium and all that. They are all private companies' initiative. Okay, so without this provision, those donations would not be deductible. So, but with this provision, whether the donation is in capital or in cash, you are now, this has provided for it that you can now deduct it. But of course, it also says that it must be based on actual cost incurred, which means there will be a verification process. Maybe FRS is the one that will handle that because you'll be making the claims to FRS, okay? And so your documentation as to how much in equipment or in a sanitizer, whatever you are provided for government, either through state or federal government, okay? And then must be backed up with document, must be verifiable, and then it is again restricted. It is just something to say thank you for helping in this period. And so that is why government has said that it is only 10% of your accessible profit after all other deductions have been made, including all other donations that are not COVID-related or pandemic-related. 10% of the accessible profit. Before now, it used to be only 10% of total profit. And you know, 10% of total profit is so small that because you will have deducted your capital allowance before you arrive at total profit. Now it says accessible profit, so which means a little bit more significant, but it's nothing really, you know, that will determine whether you make donation or not, because it's not that significant, but it's at least a recognition of your effort.
Mr. Folorunsho, what more do you think Nigerians need to know about this document as we round up this segment of the show?
Well, the important thing is everyone must be, you know, the president emphasized the fact that the revenue agencies must comply, must meet their revenue budgets.
I feel for them at this time.
And so a lot of information will be required as provided in the Finance Act. Banks will be under a little bit of some pressure because most of this information are gotten through the bank. There are specific provisions in the Finance Act, in the establishment, that will now require banks to provide information on those that are not resident, but that have accounts, you know, the CRA provision that was there. So one must be ready for it. In terms of stamp duty, the banks are also the collecting agent, you know, mostly. They deduct and they transfer to the CBN. Okay, so nothing has changed. It is just that they may now be, the law did not say that. The law says the Minister of Finance will make regulation as to how the electronic levy will be administered. Okay, there's no other person that will administer other than FRS. Okay, and so FRS will still be saddled with that responsibility of collecting those that are corporate body related, while the states are to collect for those that are between two individuals. Okay, so that area has to be noted. The issue around unclaimed dividend is not really, for me, an issue. You can still claim your money anytime you want it. Okay, the issue around custom and excise tariff reduction is significant. Okay, a lot of people can now import their cars, provided they are new, and then enjoy the reduction in levy and duty as provided in the Act. A lot of people will be happy around no VAT on rent, but of course we should expect that when the stamp duty is holistically reviewed, there may be an increase in what will apply in terms of stamp duty on those rent and property. But of course, for now, stamp duty, VAT is to be, it should not be applicable on rent and purchase of land and purchase of property. Okay, so those are areas that I think a lot of people will.
I know it's broad, and I see that passion because you're a professional in this space, so you know he's coming like. So I was just thinking, just maybe 1 minute, because I've already been told that our tax to GDP. We've been talking about this. This is a new year. Are you seeing anything different as we move on this year?
Unfortunately, we are just coming from
recession.
Are we? We are already in recession.
We are in recession.
Okay, we are coming from COVID. Are we coming, or we are still
in second wave?
And so a lot of the accounts that companies are going to be filing from March to August. A lot of people are not doing anything virtually. Okay, so I don't expect now that we should be thinking of increase in tax to GDP rate. It used to hover around 6, 5.9, and 7. I don't see any reason for any increase, even though all these are steps toward enhancing compliance with tax, increase in tax payment, but you only pay based on your activity. For example, we expect that we will now have information, those companies that are operating in the export-free zone, whether the oil and gas export-free zone and the Nigerian export free zone, they are now required to file returns, okay? Not to pay tax anyway, but at least they should provide information as to how they are doing, what activities, are they operating into the custom territory or not, so that Federal Revenue will have those details. So that's additional information that one has to take into consideration. going forward, because those companies are now required to file returns as provided in Section 55 of CETA, so like any other company. But of course, they are still exempt from tax. That is additional provision. There is also the Crisis Intervention Act, where fund of about 500 billion is to be set aside, so that in the future, when we have this type of crisis or pandemic, government will not be running around looking for funds to meet up all these issues. That is now provided in the Act, in the Finance Act, and we hope that that fund, which is in line with Section 306 of the Constitution, okay, that such funds should be set aside. So 500 billion is expected to be set aside, and government will work on that, and then they can have access to it.
All right there, Mr. Abe Folorunsho, thank you very much. Managing Consultant with Pedabo. It's been nice there, breaking it down, what it stands for, and I'm sure you have something to learn from his submission. Let's take